Today, I would like to analyze PayPal, one of the largest payment companies in the world and one of the worst performing stocks in the last 5 years. We can see here the stock price is down around 76% from the highs in 2021. In the 1-year charts, the stock price is up around 22%, so a slow recovery. But now they announced the earnings and the stock price is down around 8% again. Actually, the earnings were quite good. They had the higher earnings per share than expected and also the higher revenue than expected. So we're going to take a look at the financials to find out if it's a good buy right now. The first thing we can recognize is the market cap of 69.97 billion US dollar. This makes PayPal the 61st largest financial service company in the world. Now we're going to take a look at the financials. The first thing we're looking for is revenue growth in the last 5 years. We want to invest in a growing business and not a declining business. So in 2020, the revenue was around 21.45 billion US dollar. This was a very good growth, around 20% from 2019. In 2021, we saw the good growth around 18%. In 2022, we saw the good growth around 8%. Again, in 2023, the good growth around 8%. And then in 2024, there's a decent growth around 6.8%. So overall, I think in the last 5 years, we had a very good revenue growth. So it's a check here. The next thing we're looking for is the free cash flow growth in the last 5 years. The free cash flow is very important because it can be used to pay the dividend, to pay the stock buybacks, to invest in the business, and also to pay back the debt. So in 2020, the free cash flow was around 5.35 billion US dollar. This was a strong growth around 60% from 2019. In 2021, we saw the decline around 8%. This is something we don't like to see. Then in 2022, we saw the decent growth around 4%. Then again, the decline around 17% in 2023, and then the strong growth around 60% in 2024. So overall, I think we had a very good free cash flow growth as well, so it's also a check here. The next thing we're looking for is a free cash flow yield over 4%. So this can also tell us about the valuation of this company. The higher the free cash flow yield, the higher the indication for undervaluation. So we're going to take the free cash flow from 2024, 6.77 billion. We're going to divide it with the current market cap, 69.97. And then we're going to get the free cash flow yield for 2024. So this is around 9.67%. And that's a very good number actually. It's over the 4% that we're looking for. So a check here and already an indication for undervaluation. We can also take a look at the future assumptions about the free cash flow. In 2025, it could be around 6.5 billion. In 2026, around 7.2 billion. And in 2027, around 7.6 billion. I think maybe these numbers are a little bit too high. So let's assume for 2027, around 7.2 billion. Then we're going to divide it with the current market cap, 69.97 billion. And then we're going to get a different free cash flow yield for 2027. So the number we're going to get would be around 10.29%. And that's very good actually. We like to see that as well. And it would be also a check here for 2027. The next thing we're looking for is a debt to free cash flow ratio under 5. This means the company can repay the debt with a free cash flow in under 5 years. A very important number because if a company has too much debt and cannot repay the debt, it can risk to go bankrupt. So first we're going to take the long-term debt, around 9.88 billion. Then we're going to take the short-term debt. So we can see here this is around 1.19 billion. And then we're going to divide it with the current free cash flow. And this is around 6.77 billion. So the ratio that we're looking for is around 1.63. And that's a very good number. It means a little bit over 1 year we can repay the debt with a free cash flow. So the check here, we like to see that. We can also take a look at the cash on hand, how much money this company has in the bank. And we can see here around 10.8 billion. And that's also a very good number. We like to see that. So overall, I think this company has a very good balance sheet. The next thing we're looking for is the enterprise valuation to free cash flow ratio under 25. So this can also tell us about the valuation of this company. The lower the number gets, the higher the indication for the undervaluation. So first we're going to calculate the enterprise valuation of this company. This is the current market cap, 69.97 billion. We're going to add the debt as well, 11.07 billion. We're going to take minus the cash, 10.82 billion. And then we're going to get the enterprise valuation, so how much the whole company is worth. So the number we're going to get is around 70.22 billion. Now we're going to divide this number with the current free cash flow, 6.77 billion. And then we're going to get the ratio that we're looking for. And the number is around 10.37. And that's actually a very good number. It's under the 25, so it's a check here. And I think it's an indication for undervaluation. We can also calculate this number for 2027 with the free cash flow of around 7.2 billion. So the number we're gonna get would be around 9.75. And that's even better. So it also would be a check here for 2027. So overall, I think this is an indication that this company could be undervalued right now. The next thing we're looking for is shares outstanding decrease. This means the company buys back their own shares. We like to see that especially when the company is undervalued. So we're going to take a look and we can see here, yes, this company does a lot of buybacks. In 2024, it was close to 9%, so a huge number, and in 2025, around 1.1%. So overall, I think this is something we like to see, and I also think the company can afford it because they have a good balance sheet. So it's a check here. Can the paper stock be a good buy right now? The stock is down around 75% from 2021. So let's start with the positive about this company. I think they had a good revenue growth in the last 5 years. I also think they had a good free cash flow growth as well. This is something we really like to see. The balance sheet is also looking very good. We have a low amount of debt and a good amount of cash on hand. The free cash flow yield around 9.67% is also looking great, especially for a technology company. And in 2027, our free cash flow assumptions, the free cash yield could be around 10.29%, which would look even better. The enterprise valuation to free cash flow ratio around 10.37 is also very good. We like to see that number under 25. And in 2027, it would look even better with around 9.75. So overall, I think this is already an indication for undervaluation. What I also like about this company is that they have a lot of stock buybacks. This is very important because it can help the stock price to increase. What I don't really like is the competition. I think they have a lot of competition nowadays with Apple Pay and Google Pay. So I think this is something to keep in mind as well. But overall, I think this company does look undervalued right now. If you found this video helpful, don't forget to like and comment and subscribe for more content.